Hello, everyone. A huge high-energy thank you for clicking on this video and joining us
I
today.
really do appreciate you taking the time.
We know you could be watching anything right now, so it means a lot that you're here. And we have, I think, a fascinating story today.
Oh, for sure.
It's about a massive corporate turnaround
Mm.
that really it affects pretty much everyone who pushes a cart down a grocery aisle. We are looking at the Kraft Heinz company.
It's a really fascinating moment for them. We are digging into their Q4 2025 earnings call. And just to set the context, today is February 11th, 2026.
Right.
And this isn't just any old call. It features their new CEO, Steve Kehling, who's only been in the job for about, 6 weeks?
Only 6 weeks.
Yeah, and he's on a call with CFO Andre Nasil. And let me tell you, for a guy who's been there for, less time than it takes to grow a decent beard, Kehling is making some absolutely seismic shifts.
Seismic is the right word. It sounds like he walked in, took one look around, and just immediately started moving all the furniture. But before we get to the Q&A, which, spoiler alert, is where the analysts really tried to grill him, we should probably unpack their prepared presentation.
We have to.
Because there was a major, major headline in there about the future of the company.
Absolutely. The big headline, you can't miss it, is that the company has decided to pause the separation of its business units. The spin, as they call it.
The spin. Okay, so for a little context, the plan was to break the company up, right?
That was the plan, or at least the heavy rumor. It's sort of financial engineering 101. Break it up to unlock value and make the stock go up. But Kehling came in and just put a hard stop to all of that.
That is a huge pivot. So why? Why pause it? Was it just too much work?
In a way, yeah. The rationale he gave was that they need 100% of their focus on turning the business around, on, achieving organic growth.
Right.
He basically argued that you can't afford the distraction of a messy corporate divorce when your core business needs CPR. He wants to fix the engine, not sell off the tires.
And fixing the engine. That's not cheap. I saw a pretty startling number attached to this new plan.
Oh, yeah.
They're not just pausing the split. They are, opening the checkbook wide.
They certainly are. They are committing an incremental $600 million to the business.
Wow.
And the language he used is so important. They are explicitly trying to fix underinvestment. They're admitting, pretty bravely, I think, that they just haven't been spending enough on their brands.
So that money's going to marketing, R&D, that sort of thing.
Exactly. Marketing, R&D, building up their sales capabilities.
That is a lot of cheddar,
Yeah.
Literally and figuratively for Kraft. So what does this spending spree mean for their financial outlook? Are they just going into massive debt?
They're trying to be responsible. They set some clear guardrails. They're targeting a leverage ratio of approximately 3 times, which is, pretty manageable.
Okay.
The goal is to use 2026 as a repair year, exit with momentum, and then get back to real organic growth by 2027. But they did flag one very specific and kind of thorny headwind.
Right, the S&P funding.
Exactly. They're expecting a 100 basis point impact. That's a full 1% drag on sales from changes to the Supplemental Nutrition Assistance Program.
And we will get into why they're so exposed to that later. Okay, so just to recap the setup. The split is dead, or at least sleeping. They're spending $600 million to fix the brands. They're bracing for a hit from reduced food stamp benefits. And they're promising growth by 2027.
That's the stage.
So now let's get into that Q&A, because this is where we really see how Wall Street reacted to this whole new direction.
And the first question came right out of the gate from Andrew Lazar with Barclays.
Right, and Lazar didn't waste any time. He went straight for that $600 million figure. His question was basically, is this money just catching up, or is this a new higher baseline because the industry is just, tougher now?
The classic, is this offense or defense question. And Steve Kehling gave a really candid response. He flat out admitted that historically Kraft Heinz was underinvested.
He didn't blame inflation or the retailers or anything.
No, not at all. He said this spend is about getting back to sufficiency.
Sufficiency. That is such a corporate way of saying we weren't doing enough.
Precisely. He said they weren't spending what they ought to be to drive competitiveness. And he used this to reinforce the decision to pause the spin.
Ah, so he tied it all together.
He did. He argued that this need for intense focus and, resource allocation is exactly why they can't split up right now. They just can't afford the distraction.
Makes sense. If your house is on fire, you don't spend time planning a new addition. You put out the fire.
Right.
Okay, next up was Peter Galbo from Bank of America. And he asked the question I think was on everyone's mind about the timeline.
Yeah, the whiplash question. Galbo pointed out that just 4 weeks ago, the spin seemed like it was on. Now it's paused. He asked, why the sudden change?
Well,
And is this pause temporary or indefinite?
it's a fair question. 6 weeks is barely enough time to find the bathroom in a new office, let alone change the entire corporate strategy. How did Kehling explain that?
He threaded the needle pretty well, actually. He said that when he took the job, he endorsed the spin in principle, but, and I love this phrase, he reserved the right to get smarter.
Huh. I'm going to use that.
Me too. He said after 6 weeks under the hood, he found immediate opportunities to fix the business that required, quote, finite resources.
Finite resources. That's the key, isn't it?
It is. He's saying they don't have infinite money or people. They can do the separation or they can fix the brands. They can't do both.
So what about the timeline? Is it coming back?
He said the pause has no end date. They'll reevaluate later, but for now it's all about organic growth. He's preserving the option, but 2027 success is the prerequisite.
So earn the right to split later by growing now.
Got it. Okay, next we had David Palmer from Evercore ISI. He wanted to get into the nitty-gritty of that money. He asked how they got to that specific $600 million a number, what the phasing looks like, and, which brands get the cash first. Kehling and the CFO, Andre Maciel, tag-teamed this one. On phasing, they said the spend ramps up in Q2 of this year. They expect to see meaningful results, so actually bending the sales trend in the back half of the year.
And where's the cash actually going? Is it all just like Super Bowl ads?
Not quite. It's an interesting allocation. About half is for price, product, and packaging.
So making the food better and the boxes nicer.
Basically.
Yeah.
The other half is for SG&A, specifically for building up their commercial teams.
And did they say which brands get the big makeover?
He did. They pointed out that their taste elevation platform, that's Heinz Ketchup Philadelphia Cream Cheese, is actually already doing well.
Right.
The big fix-it project is the North American grocery portfolio. That's your Oscar Mayer, your Kraft Mac and Cheese. That's where the trends are hurting, and that's where the investment is going.
Got it. Fix what's broken in the U.S. grocery aisle. Which, speaking of geography, leads us perfectly to Steve Powers at Deutsche Bank.
Right. Powers wanted to define the terms. He asked, how do you define short-term for this turnaround? Is the separation paused until 2026 or later? And crucially, is this investment U.S.-focused or global?
It feels like the analysts were really trying to pin him down on a date for that spin.
They were, and he just wasn't giving it to them. He kept pivoting back to the work. On geography, he was crystal clear. The investment is disproportionately focused on the U.S.
That's where the problem is.
That's where their trends are lagging, so that's where they're pointing the fire hose.
And the timeline? Did he give anything there?
He just reiterated the plan. 2026 is the investment year. The goal is to exit 2026 with their best trends and hit organic growth in 2027. As for the spin, no date. He basically said, don't ask me about the divorce until the marriage is healthy again.
I love that analogy. Okay, next up, Robert Moskow from TD Cowen. He asked a question I thought was pretty tough. He basically asked about the losers in the portfolio.
It was a sharp question. He asked, do some brands simply not respond to investment? The antiquated brands that maybe people just aren't buying anymore.
The good money after bad question.
Exactly. And he also asked if they're behind on coordinating their commodities, like meat, coffee, and cheese.
How did they handle that?
Kehling was realistic. He admitted not every single brand will grow. He knows that. But the strategy is that the winners have to outpace the challenged ones. And then they dropped a specific example of a potential winner that I know caught your attention.
Oh, absolutely. The Super Mac.
The Super Mac. They're betting big on innovation for mac and cheese, launching a version with 17 grams of protein per serving.
17 grams. That's legitimate protein. That's not just comfort food anymore. That's like post-gym food or something.
That's the idea. They're trying to make these legacy brands relevant to a modern consumer who cares about macros.
Interesting. And what about the commodities question?
Maciel, the CFO, jumped in on that. He said they remain disciplined on their pricing. He admitted they can't control if a competitor does something irrational, but Kraft Heinz isn't going to start a price war that destroys their own margins.
Smart. Don't race to the bottom. Okay, next, Michael Lavery from Piper Sandler. He wanted to talk long-term math, algorithm as they call it, and of course, share repurchases.
Ah, yes, the algorithm question. Wall Street loves the formula, but management just shut that down.
Really?
Yep. They said it's simply too early to talk long-term algorithms. The focus is entirely on 2026.
And the buybacks. I assume that was a no as well.
A definite no
Yeah.
for now. They were very clear on their capital priorities. Number one is investing in the business, that's $600 million. Number two is keeping leverage around 3 times. So any extra cash in 2026 is going to pay down debt, not buy back stock.
That brings us to Leah Jordan from Goldman Sachs. She circled back to that specific headwind we mentioned at the top, SNAP. She wanted the details. What is Kraft Heinz's exposure, and how bad is the reduction in benefits going to hurt?
This was a really eye-opening data point for me. They reveal that Kraft Heinz has about 13% exposure to SNAP.
13%. Wow. What's the industry average?
The industry average is around 11%. So Kraft Heinz is over-indexed on consumers who rely on assistance, which means when benefits get cut or when inflation eats into those benefits, Kraft Heinz feels the pain more than their competitors do.
And they modeled a 100 basis point hit from this. So what's the plan to fight it?
They view it as a challenge, but also an opportunity. They plan to win with what they call opening price points.
Which just means cheaper options.
Exactly. Cheaper entry-level options and smaller pack sizes. If a consumer has less money to spend, you need to offer them a product that fits that tighter budget.
Which transitions perfectly to Chris Carey at Wells Fargo. He asked about the mechanics of that. You know, promotions, which are fast, versus price pack architecture.
Which is just a fancy way of saying changing the size of the box.
Right, which takes a long time. So which is it?
Yeah. And the answer was a mix of both. Kehling and Maciel explained that quick adjustments to promotions and pricing can happen, right now. But the structural changes, making those smaller packs, that takes time.
So the impact will be more in the back half of the year.
That's what they said. The incremental price investments will show up more in the second half. And they noted these opening price points will impact about 40% of their categories.
Okay, last question. John Baumgartner at Mizuho Securities. He zoomed out a bit.
Yeah, this is a great closing question.
He asked, beyond the money, what about the soft skills? How do you improve the culture, the retailer relationships, the consumer connection?
And Kehling was brutally honest again. He said the company is lean, and he did not mean it as a compliment. He suggested they might be too lean in their commercial areas.
Too lean. I feel like most CEOs brag about being lean.
Right, but he implies they cut too much muscle. He said they need to hire sales and marketing pros. And he specifically mentioned investing in technology, especially AI.
AI for ketchup.
It's about data. He wants to show up to retailers not just with a palette of products, but with a growth plan that actually excites them. He wants Kraft Heinz to be a strategic partner, not just a vendor filling a shelf.
It sounds like he wants to bring some swagger back to the company, shift from playing defense to playing offense.
That is exactly the vibe I got.
Okay, we have covered a ton of ground here. The paused spin, the $600 million bet, the Super Mac, SNAP headwinds. If you had to synthesize all of this for everyone watching, what are the main themes?
I think it really boils down to 4 distinct pillars here that summarize the whole situation.
Okay.
First is the pivot. This is a definitive shift away from financial engineering, the spin-off, and toward an operational fix.
Right. Build, don't just cut.
Exactly. Second is the bet. This is a $600 million wager that their legacy brands like Mac and Cheese and Oscar Mayer are not dead. They believe these brands will respond to marketing and better pricing.
A big bet. And the third?
The geography. This is a U.S. rescue mission. They're focusing their firepower on fixing the home front because that's where the ship is leaking.
And finally?
The timeline. And this is crucial for anyone watching this space. 2026 is a fix-it investment year. They are telling everyone right now, don't expect miracles this year.
Right. This year's for repairs.
Exactly. This year is for stabilizing. 2027 is the target for real growth.
That is a crystal clear breakdown. It's going to be absolutely fascinating to see if Super Mac and a $600 million check can turn this giant ship around.
It certainly will be.
Yeah.
It's a bold move by a new CEO, but honestly, it sounds like the move they had to make.
We will definitely be watching to see if they hit those Q2 benchmarks. Thank you so much for watching this video with us. If you found this breakdown helpful, please do us a huge favor. Click that like button, share this with a friend or a colleague who follows the industry, and please subscribe to the channel so you don't miss our upcoming content.
We'll see you next time.
See you next time.